Hey guys, Matt here. So this is a video done by request in which I will go over the Dish stock. So Dish is a company that until recently operated solely in the pay TV department. They offer services like Dish TV, which is their satellite service, and then they also offer Sling TV, which is their over-the-top internet-based streaming service. Recently, I think as of 2019, they got into the wireless space. They made some acquisitions, Boost Mobile and Ting Mobile, and I think 2020 was the first year that they started booking significant revenue for them. And I gotta say, this was an interesting and difficult company to look into. I'll show you why. So as of the recording of this video, I'm filming this on Sunday, you'll be seeing this on Monday. Dish Network trades at $31.51. Just FYI, they do not pay a dividend. If you take a look at their statistics, you will see that these numbers look really good. Trailing PE looks pretty good. Their forward PE looks really, really good. And then their PEG ratio, price to sales, price to book, enterprise value, all these look really cheap. And if you do your research, and I implore you to do that, and you like the company, by most of these valuations, this stock is trading at a good price. Now, low valuations are good and all. They mean the company is trading cheap, but they also might mean the company is not doing well. So let's look at some of the other numbers. So for a lot of this, we're going to take a look at the company's latest 10K, which recently came out. And that's because we're going to get a lot more information out of this than if we went through just Yahoo Finance. So from 2018 to 2019, they actually dropped in revenue, but from 2019 to 2020, they rose a lot. And this is undoubtedly due to the inclusion of their wireless revenue. Now, looking towards the bottom line, especially from 2019 to 2020, this is not a bad jump. They went from $1.8 billion to $2.5 billion in operating income. And as far as their bottom line, their net income, $1.3 billion to $1.7 billion. So that is not bad financially. And of course, earnings per share also jumped up substantially since last year. Although they did, from 2019 to 2018, they did drop significantly. So that is something to keep in mind. Balance sheet doesn't look too bad from when you compare the end of this year versus the end of last year. As far as total assets, they went from $33.2 billion to $30.2 billion. Their cash jumped up, which is really, really nice. Their liabilities jumped up as well as their debt, which is okay, fair enough. So all in all, it's not a terrible balance sheet. The debt is going up, so as long as they're performing well financially, that shouldn't be too much of a problem. But I would like to see that be a little, I would like to see it go down instead of up. Cash flows jumped up as well, as far as operating cash flow, so that's pretty amazing when you compare the years. Now even 2019 versus 2018, when they dropped in net income and dropped in revenue, they still did better in operating cash flow versus 2018. So these are not bad cash flow statements at all. So as far as just the numbers from their valuation and the numbers in their 10K, they don't look too bad. Not too bad at all. But there are some risks. And these are pretty big ones. So the biggest part of their business operates in the pay TV space, whether it's satellite or on-the-top internet-based Sling TV. I could show you news articles or whatnot, but let's just take it straight from the 10K. Satellite TV is an industry that has been in decline over the past several years, thanks to a rise in internet-based streaming services such as Netflix, Hulu, Amazon, Alphabet, Disney, and so on and so on. And Dish TV straight up admits it right here. Now, I'm not going to read this whole thing. You can pause it if you want to read it, whatever. But what I'm trying to say is they're facing increased competition from companies and stuff that are, let's face it, kind of doing a better job at offering TV-based services than satellite TV is. So if you went with their Dish service, you can get 190 channels starting at $64.99 per month, and then it goes up for there. Now, the problem with this, from a consumer standpoint is, yeah, 190 channels sounds great, and 190 more channels sounds great, but, is anyone really going to watch all 380 channels? I don't think so. It is a much better value to pay for Netflix or Hulu and then watch when you want, whenever you want, at a much cheaper price. Now, that's not to say that there isn't a market for satellite TV anymore. I mean, satellite TV is in decline, but I don't know if it's a straight downfall. I mean, there are many parts of the world that still rely on that service, such as rural areas, bars, restaurants, and other commercial entities. Like, a lot of those places are still going to use satellite TV. So there's still a market for it, especially in the short term, the next 3 to 5 years. But the fact that it's declining now does not speak volumes for growth. So here's the pay TV section of the revenue, and this is the information I want to talk about. Now, they did jump in revenue, which is fantastic, and they did jump in operating income, which is also fantastic, given, mostly due to the cost cutting and their operating costs. But this is the part right here. This is their pay TV subscribers, both Dish and Sling. You will find that in 2019 they lost 336,000 pay TV subscribers, and in 2020 they lost just over 500,000 of those subscribers. Now that's the part that kind of worries me. Now I'm glad they were able to gain an increase in revenue and operating income while losing subscribers, but my fear is, will this continue? Will they continue to gain or even break even on revenue if they keep dropping subscribers? I'm pretty sure Dish isn't stupid. They know that pay TV is in decline. I mean, they said so in their 10K. And that is probably at least part of the reason they wanted to get into other industries, such as wireless. So looking at their wireless segment, they are reporting some pretty good revenue, and they also are walking out of this with operating income. However, this year, they also netted a loss of over 500,000 subscribers. Now, that also kind of worries me because they're just starting out and they're losing subscribers. Now, will they continue to lose subscribers over the next couple of years? That remains to be seen. I mean, they could lose some more. They could also turn around and gain some more. I mean, they're also putting in some work investing in the whole 5G network deployment, which, I mean, they're gaining some revenue. And, I mean, they're losing a chunk in operating income, but, I mean, they're just now deploying it. So they're probably not going to see profit from this for a while. And another concern of mine is that they are trying to enter into an industry that's already pretty saturated with lots of wireless and 5G players. AT&T, Verizon are just a couple of them. And they're going to have to contend with them. So I'm not sure, I mean, I'm not smart enough in the industry to know whether Dish is going to make it or not, but I guess they're trying. So as far as the numbers on the valuations, the Yahoo valuations and stuff, I mean, they all look fine. They all look very attractive. However, I'm a little worried about the future because when you're buying a stock, you should be buying it for 3 to 5 years out. And I'm a little concerned about their ability to maintain strong revenue or grow it or at least break even going forward, with the loss in pay TV subscribers and with the loss of wireless subscribers, if those losses continue. If you look at the Yahoo analyst estimations, now this is not gospel because a lot of things could change over the year, so do not take this as set in stone. 2021, an EPS of 3.02 to 2.83. 2022, estimated to go down to 2.44. So analysts are expecting a loss between the end of this year and the end of next year. The number at the bottom, after that, they are expecting a loss of 30.83% each year after next year for the next 5 years. So do I think Dish TV is a buy? Well, that's very difficult to answer because it depends on my opinion, or if you're trying to decide, it depends on your opinion as to whether Dish's pay TV services are going to continue to drop, whether they're going to even up, or whether they're actually going to grow. And it also depends on their wireless segment, whether that's going to drop, flatten out, or grow. And only time will tell for that. Now, I do know that there is a possibility that Dish will merge with DirecTV, but I mean, there's been no news about that whatsoever. All those are rumors. If they do merge with DirecTV, then that's probably going to be a huge boon for Dish. But since rumors are the best they are right now, we're not gonna include them in our calculations. But let's go over some. Let's try to come up with some fair values. One way, if we just go by a PE ratio, we can take the 4 PE of the industry average, which is 37.79, and we can multiply that by 2.41, which is the expected EPS at the end of 2022, and then work backwards from there. I know you can't see it in this calculator, so I'll put up a graphic that shows the numbers. I got a fair value of roughly $67.74. Here's a quick edit. Assuming you wanted to get even more conservative and you want a PE of 20, the same calculations will give us about $35.84. Now, I also put together a few discounted cash flow projections. The first one is taking into account the past revenue growth and the past free cash flow growth, average them out, and then use that as the forward numbers. If I do that, onward to 2026, I get a fair value of $74. However, so what I like to do is, depending on how sure I am of the fair value, and I know this looks like shit, but I just threw this together on a whim. Depending on how sure I am about the fair value, I would either take 90% or 80%. I'm not so sure about this because I don't know which way, the growth's going to go. So I'll take 80%, and that gives me a fair value of $59.20. I also took one more projection, assuming the worst, but reasonably the worst. Assuming that year over year, DISH drops in revenue by as much as the Yahoo analysts say. Now, this is almost certainly not going to happen. It might happen, but I don't think it will. But assuming a bad scenario, I did my numbers here, and assuming I want a 10% return every year, I got a fair value of $22.65. Since I'm really not sure about this, that puts me to $18.12. So like I said, yeah, it's a tough one to decide. Now, personally, I think I'm going to stay on the sidelines and watch the stock for a bit. However, if you think this company's going to grow, then it's probably trading at a pretty good price right now. Again, it's up to you and your own research. So anyways, what do you think about DISH? Is it a buy to you? Is it a hold? Is it a stay away? Let me know in the comments. But anyways, take care, have a great day, and eat your vegetables.